Welcome to lecture number 24. Lecture number 23 we started with the basics of budgeting. We did the flow of how the master budget is made. The first step is when you make the operating budgets, and then from the operating budgets, you get the budgeted income statement, and using that budgeted income statement, you make the financial budgets. Now we will start with the preparing the operating budgets. We use a case study of Hayes company in preparing the operating budgets. Hayes manufactures and sells a single product. So हमारी जो case study में जो company है, it is called Hayes company. It is into production and selling of a single product, which is a bike seat with multiple customizable adjustments, and that product is called Right Ride. The budgets are prepared by quarters for the year ending December 31, 2014. So quarterly आपकी budgeting है. Hayes company begins its annual budgeting process on 1st September 2013, and it completes the budget for 2014 by December 1, 2013. As we discussed in lecture number 23, आपकी budgeting is a long process. That is why they start it on 1st September 2013 and they end it by December 1st, 2013 for the next financial period, which is 2014. Now we will discuss the sales budget. As shown in the master budget in illustration 21.2, the sales budget is prepared first. आपका ये आ गया sales budget. So it is always the first step in making the master budget, or you can say it is always the first budget that is prepared, and then you use the sales budget to make the other budgets. The sales budget is derived from the sales forecast. It represents management's best estimate of sales revenue for the budget period. An inaccurate sales budget may adversely affect net income. How? An overly optimistic sales budget may result in excessive inventories that may have to be sold at reduced prices. If you estimate that for the next financial period you will have a lot of sales, so obviously आप उसी के हिसाब से you will adjust the level of inventories that you should have to take care of those sales. And if the sales figure is very high compared to the reality, तो obviously आपका जो inventory का level है वो भी बहुत high रहेगा, and you will have to sell the inventory at a very less price. For example, at one time, Amazon.com significantly underestimated demand for its ebook reader, the Kindle. As a consequence, it did not produce enough Kindles and was completely sold out well before the holiday shopping season. Not only did this represent a huge lost opportunity for Amazon, but it exposed it to potential competitors who were eager to provide customers with alternatives to the Kindle. So, इससे आपको idea होगा कि it is very important that you should not underestimate, and you should also not overestimate your sales figure for the next financial period. Forecasting sales is challenging. For example, consider the forecasting challenges faced by major sports arenas whose revenues depend on the success of the home team. आपका जो Madison Square Garden है, उसका revenue from April to June was 193 million during a year when Knicks made the NBA playoff. So जो आपकी sales हैं, sales can be affected by a lot of external factors, which maybe you are not in a position at the time of making the budget to foresee. So it is very important that you always keep in mind all these constraints and all the unknown factors which can have a big impact on the budget that you have made. The sales budget is prepared by multiplying the expected unit sales volume for each product by its anticipated unit selling price. Hayes company expects sales volume to be 3,000 units in the first quarter, with 500 unit increases in each succeeding quarter. As I've already mentioned, the budget that we are making is for the financial period 2014, and the period starts from 1st Jan 2014 and it ends at 31st December 2014. आप expect कर रहे हैं कि for the first quarter your sales will be 3000, and then quarterly you will have an increase of 500 units per quarter in sales. So for the first period it is 3000, obviously for second quarter 3500, then 4000, and then 4500. Using all these four figures you can calculate the expected unit sales for the whole financial period. We know the selling price is $60 per unit. So when you multiply the unit selling price with the expected unit sales, you get the total expected sales. So you expect for the financial period 2014, your total sales will be $900,000. This is called the Hayes Company sales budget. Some companies classify the anticipated sales revenue as cash or credit sales and by geographical regions, territories or salesperson. So ये जो आपका sales budget है, you can further refine it and you can add more data to it using regions, using the salespeople, or by distinguishing the total sales that you have calculated here into credit sales or cash sales. The second budget that we make is called the production budget. The production budget shows the number of units of a product to produce to meet anticipated sales demand. Production requirements are determined from the following formula. Now it says to meet anticipated sales demand. So once we have made the sales budget, now we know the expected sales that we will have throughout the year. So you use those anticipated sales to make your production budget. The formula for production budget is budgeted sales unit, we know, plus desired ending finished goods unit minus beginning finished goods unit will give you the required production units. The formula ignores any work in process inventories which are assumed to be non-existent in Hayes Company. Now, what is the concept behind units of finished goods inventory? For example, आप देखेंगे this is the T count for the units of finished goods inventory. So since it is finished goods is considered as your current asset, so आपकी beginning inventory comes on the debit side. ये आपकी beginning finished goods units आ गए. उसमें you add required production units, जो आपके required production units है, तो obviously you will debit the required production units, and जो sales होंगी वो आपकी होंगी reduction in the units of finished goods inventory. Why? क्योंकि जब आपकी sales होंगी तो obviously this will go to the cost of goods sold, और वो आपकी sales की वजह से this unit of finished goods inventory will decrease. So the balance will give you the ending inventory. A realistic estimate of ending inventory is essential in scheduling production requirements. Excessive inventories in one quarter may lead to cutbacks in production and employee layoffs in a subsequent quarter. On the other hand, inadequate inventories may result either in added cost for overtime work or in lost sales. So when you are estimating the ending inventory that you want for each quarter, you have to be very precise and accurate, as whether you overstate it or understate it, it will have an adverse effect on your business. Hayes company believes it can meet future sales requirement by maintaining an ending inventory equal to 20% of the next quarter's budgeted sales volume. अब now we know the budgeted sales volume for each quarter. So it says that ending inventory should be 20% of it. For example, ending finished goods inventory for the first quarter is 700 units. Why? Because आपकी जो anticipated second quarter sales हैं 3500 की, उसका जो 20% है, this is your 3500, so उसका 20% comes to 700 units. So now we calculate the production budget. We already know the expected unit sales. Your illustration 2130 में we have already calculated, which is here. So you have the expected unit sales, then you add desired ending finished goods unit. Now, how do you calculate it? It is 20% of next quarter sale. So जो next quarter sale है उसका 20% है, तो obviously this will give you the desired ending finished goods unit. So from this you get the total required units, and you subtract beginning finished goods unit from it to get the required production units. अब expected जो आपका B है, which is the the desired ending finished goods units for the quarter 4, which is 1000 units. How do you calculate it? It is the expected 2015 first quarter sales, which were estimated to be 5000 units. So uska 20% will give you 1000. And when we talk about beginning finished goods unit, so this 600 first figure, how do you get it? It is the 20% of estimated first quarter 2014 sales unit. 2014 sales unit आपके first quarter का 3000 था, so इसका जो 20% when you calculate, that will give you 600. So this way you get the required production units for each quarter and for the whole year. The production budget in turn provides the basis for the budgeted cost for each manufacturing cost element as explained in the following page. Now we already know the manufacturing cost आपकी कौन सी है? Direct material, direct labor and MOH. Now the direct materials budget shows both the quantity and cost of direct materials to be purchased. The quantities of direct materials are derived from the following formula. This formula, when you look at this formula, it is the same as when we are calculating the production requirements formula. So you get the direct material unit required for production plus desired ending direct material unit minus beginning direct material units. You get the required direct material units to be purchased. So it has the same methodology as this formula. After the company determines the number of units to purchase, it can compute the budgeted cost of direct materials to be purchased. It does so by multiplying the required units of direct materials by the anticipated cost per unit. So we have already calculated the required production units for each quarter. Now we will use that as the starting point for the direct material purchases. We know the units to be produced for each quarter, which is here. Now it has given us further data. For example, the inadequate uh, for example, inadequate inventories could result in temporary shutdowns of production. So that is why the desired ending inventory is again a key component in the budgeting process. Hayes Company maintains an ending inventory of raw material equal to 10% of next quarter's production requirement. The manufacturer of each ring, right, we know that is the name of the product, requires 2 pounds of raw material. So हर एक में जो raw material की quantity है, that is 2 pounds in each unit. The expected cost per pound is 4. So expected cost per pound is 4, and total 2 units are required for total 2 pounds are required for each unit. So the total cost will be obviously $8 per unit. Illustration 21.7 shows the direct material budget. Assume that the desired ending direct materials amount is 1020 pounds for the fourth quarter of 2014. अच्छा, आपका units to be produced comes at the top. Direct material per unit we know is 2 pound. So if the total number of units that you aim to produce are 3100, so you will need total 6200 pounds for those units. And at desired ending direct material pound, we know how to calculate it. It is 10% of next quarter production requirement. So when you add it, you get the total materials required, and from that, when you subtract the beginning direct materials level, you get the direct materials purchases. Now here it says B. B is the 10% of estimated first quarter pounds needed for production. So you get the direct material purchases. We know the cost per pound is $4. So you get the total cost of direct material purchases for each quarter and the total year. And this is the T count for the unit of direct material purchases. For first quarter, it says 620 beginning direct material level. Then you have 300, which is the direct material purchases for the year. And you get this 6200, which goes into the obviously, total pounds needed for production. So you get the closing balance as 720. Direct labor budget. Like the direct materials budget, the direct labor budget contains the quantity, hours, and cost of direct labor necessary to meet production requirements. The total direct labor is derived from the following formula: units to be produced into direct labor time per unit into direct labor cost per hour. This is the cost, this is the total number of hours needed, and this is the total number of units to be produced. So you get the total direct labor cost. Direct labor hours are determined from the production budget. At Hayes Company, 2 hours of direct labor are required to produce each unit of finished goods. For example, अब हमने देखा था first period में जो finished goods if were needed were let's say 3100. So if you multiply it with the direct labor hours, total number, so you will get the total number of hours. At his company, 2 hours of direct labor are required to produce each unit of finished goods. The anticipated hourly wage rate is $10. So we already know the units to be produced for each quarter. We multiply it by the per unit how many hours are needed, 2 hours. We get the total required direct labor hours, which is 6200. And when we multiply it with the rate, we obviously get the total direct labor hour for each quarter. And then we get the total direct labor cost for the whole year. An important assumption in illustration 21.9 is that the company can add to and subtract from its workforce as needed, so that the $10 per hour labor cost applies to a wide range of possible production activity. The direct labor budget is critical in maintaining a labor force that can meet the expected levels of production. So when we know the expected level of production, so it is very critical to make the direct labor budget so that we know and we should be able to prepare the labor force which can meet our requirements. Manufacturing overhead budget. Manufacturing overhead, you already know, you get the indirect material, you get the indirect labor, and you get other indirect costs related to manufacturing. The MOH budget shows the expected manufacturing overhead cost for the budget period, and as illustration 2110 shows, this budget distinguishes between variable and fixed overhead costs. Now it has given us the details. Hayes Company expects variable cost to fluctuate with production volume on the basis of the following rates per direct labor hour. Per direct labor hour, you will have indirect material $1, indirect labor $1.4, utilities $0.4 per direct labor hour, and maintenance will be 20 cents per direct labor hour. Thus, for the 6200 direct labor hours to produce 3100 units, 6200 direct labor hours. Now, from where do we get this 6200 direct labor hours? From here. Budgeted indirect materials are 6200. Obviously, it is $1 per direct labor hour. Budgeted indirect labor is 8680 using the 6200 figure. And so this way, at Hayes Company, overhead is applied to production on the basis of direct labor hour. Thus, as illustration 2110 shows, the budgeted annual rate is $8 per hour. Now, how do we calculate it? We know the variable cost. We already know the indirect material per direct labor hour. So we use the total number of direct labor hours to calculate the indirect material. Then we calculate the indirect labor, utilities, maintenance. When we add all these, we'll get the total variable cost for the whole quarter number 1. So in this, we add the fixed cost using the assumed data. So supervisory sales are 20,000, depreciation, property, taxes, and insurance maintenance. So this way we get the total fixed cost. And when we add these total fixed costs to the total variable cost, we get the total manufacturing overhead. And when we we already know the direct labor hours for each quarter. So when we use this figure of direct labor hours, we get the manufacturing overhead rate per direct labor hour. We know it for the whole year is 246,400. We divide it by the direct labor hours. So we get the total figure. Selling and administration expense. His company combines his operating expenses into one budget, the selling and administrative expenses budget. This budget projects anticipated selling and administrative expenses for the budget period. This budget illustration 2111 also classifies expenses as either variable or fixed. So now we're talking about the selling and administrative expense budget. It has given us the figures that sales commission will be $3 and freight out will be $1 per unit of sales. Variable expenses per quarter are based on the unit sales from sales budget. For example, Hayes expects sales in the first quarter to be 3,000 units. The sales commission expenses is 9,000. You already know the figure per unit. And freight out, you know, it's $1. So you get the total figure for freight out using that. Fixed expenses are based on assumed data. So we get the sales commission $3 per unit. Then we calculate the freight out. So this way we get the total variable expenses. Then we get other fixed expenses, the assumed data. And when we add these with the variable ones, we get the total selling and administrative expense. Now, how do we make the budgeted income statement? The budgeted income statement is the important end product of the operating budget. So once you have made all the operating budgets, then you come to the end part, which is making the budgeted income statement. This budget indicates the expected profitability of operations for the budget period. The budgeted income statement provides the basis for evaluating company performance. Budgeted income statements often act as a call to action. Now, how they make the first, you have to calculate the total unit cost. We already know direct material 2 pounds are needed. We know cost per unit is 4. So we calculate direct materials is $8 per unit. We know direct labor 2 hours. We know the rate, so it comes to 20. We have already calculated the manufacturing overhead, which is $8 per hour. So for 2 hours, it will be 16. So the total unit cost is 44. Hayes company then determines cost of goods sold by multiplying the unit sold by the unit cost. Its budgeted cost of goods sold is, we already know the total figure. So we know the cost per unit. So we can calculate the budgeted cost of goods sold. Sales, we already know, we calculated that figure in the sales budget. Cost of goods sold, we have just calculated. So you get the gross profit. From that, you subtract selling and administrative expense, which was calculated in illustration 2111, which is here. So it gives you the selling and administrative expense budget. So what we are doing here is we are using all the budgets that we made previously to enter data into this budgeted income statement. So selling and administrative expenses we get from illustration 2111. We get income from operations, interest expense, they have already total income before income taxes. Income tax you calculate and you get the net income. So this is how you make the budgeted income statement using the all the different types of budgets that you made previously. Then you use that data to calculate and make the budgeted income statement. So this is the end of lecture number 24. Lecture number 25 may we will do the financial budgets.